Attention, all attendees are in listen-only mode.
Hello everyone and welcome to today's webinar, Franchise Fee Pitfalls and How to Identify Them. Before we get started, I would like to go over a few items so you know how to participate in today's event. You should see your GoToWebinar control panel on your computer desktop in the upper right-hand corner. You have joined the presentation listening using your computer speaker system by default. If you would prefer to join over the telephone, just select telephone in the audio pane and the dial-in information will be displayed. If you have selected mic and speakers and are having any difficulty, please toggle the telephone option in your control panel and dial in. If you're experiencing any other issues, please type in the details in the question section of your control panel. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation. We will collect them and address them during the Q&A session at the end of today's presentation. I would now like to introduce Elaine Papadopoulos, partner, Citrin Cooperman, and Paul Dailey, partner at Citrin Cooperman.
Thank you very much. Welcome attendees. We hope you enjoy the content and it's relevant. We feel it's very important in the franchising industry and we are glad that you're joining us today. Also note that you'll be getting CPE credits for this. So at the end of this webinar you'll be given some instruction on what you need to do to get the credits themselves. So let's start with the introductions. My name is Elaine Papadopoulos, and I am an audit and accounting partner in our franchise practice group here at Citrin Cooperman. I have been practicing in this industry for about 16 years and have worked with many franchisors and multi-unit franchisees during that time that have either been startups or have turned into established concepts. The subject we will cover today is something our franchise clients need to understand and can make a large impact on their financial reporting. And so I'll be covering the financial reporting aspect of franchise fees. Additionally, our firm is a proud member of and heavily involved in the International Franchise Association. Presenting with me, luckily, is my associate Paul Dailey. Paul?
Why, thank you, Elaine. Hello, everyone. It is my pleasure to be at this webinar and to be able to present. Again, my name is Paul Dailey. I'm a tax partner in the franchise practice group. As you can see by my picture, I've been doing this for quite some time. My practice is extremely diversified, but I do have the specialty in franchising sector and also have a specialty in the international sector. I think the key is in deferred revenue, that Elaine will give the accounting rules, but it's something that really has a lot of tax consequences, and we're going to emphasize that what we want to do is to provide the rules so that there's no surprises. You may not like the result from a tax perspective, but at least in terms of your guidance, it needs to be proactive as compared to reactive. And with that, I'll turn it back to Elaine.
Thank you, Paul. Okay, so today's agenda. We're going to briefly discuss franchise fees just so that we all understand what we're talking about specifically about which fees specifically are we talking about that we need to think about for financial reporting or tax reporting methods. We're going to discuss how to recognize them in both aspects and how they're being regulated. We're going to go over some examples, and we're going to allow you guys to have some Q&A at the end of each one of our sections. Yeah, so we'll move on. So, poll question 1. What we'd like you to do actually here.
Our first polling question is, how are financials prepared in the franchise disclosure document that are required for filing in registration states? The options are A, tax basis, B, accrual basis, C, under generally accepted accounting principles, and D, cash basis. Please select the appropriate response and click submit. So we're going to go ahead and keep this open for a few more seconds to give everyone a chance to vote. So again, go ahead and respond right on your screen. Great. So I'm going to go ahead and close the poll and share the results. Great. So I'm going to go ahead and hide the results.
Okay, so it seems that most of you have gotten the correct answer, which is generally accepted accounting principles. It's actually described within the guidelines of completing a franchise disclosure document, that the audited statements that are being attached to this franchise disclosure document have to be under U.S. generally accepted accounting principles, and that's what we're going to be discussing in the next slide. So franchise fees. The word franchise fees actually is used by the accounting, the people who regulate the accounting guidance. They call franchise fees for everything, actually, even continuing fees. We're not going to discuss continuing fees, which I guess most franchisors know them as royalties. What we're going to be discussing is initial franchise fees. And the way they define it is consideration for establishing a franchise relationship and providing some initial services. Initial services can be confusing. You know, in most cases, people don't understand what the initial services are. But generally, they're outlined in a franchise disclosure document. That's going to actually describe a lot of what a franchisor will do to help a prospective franchisee or a franchisee that has signed a franchise agreement. When are franchise fees collected? Well, these fees are obtained through a franchise agreement, but it doesn't necessarily mean that a fee has to be paid. In today's webinar, we're going to be discussing the franchise fees that are being collected initially when someone signs a franchise agreement. So let's move on and talk about initial services. So what are initial services? And there are some examples that are being described within the accounting guidance. Here are some of the initial services that are described. It could be assistance in selecting a site. It could be assistance in obtaining facilities. As you see here, there's some assistance in advertising. Most franchisors will be doing a lot of the training of the franchisee's personnel, and in some cases, it could also include some testing, where the franchisee has to pass certain examinations by the franchisor before they're even able to complete their initial services. Preparation and distribution of manuals, some bookkeeping and advisory services. It also could mean, like what we just mentioned, inspection, testing, and other quality control programs. I mean, support like this, these initial services, sometimes it can be up until the actual franchisee operates. So, but most of these initial services are going to be described in very big detail within the franchise disclosure document. And initial services are important. Once the franchisor knows what are the initial services that they're going to be providing, it'll help them, and you'll see in the later slides, it'll help them to identify when they should be recognizing franchise fees. So let's go over what the rules are. So just like in school when you were taught 2 + 2 is 4, what are the rules? You know, what is your knee-jerk reaction, your first reaction when you're collecting franchise fees? Well, when you first collect them, you think, let's deposit, let's spend, let's show some great income and show that the company is doing well. Well, that's the first reaction, but the reality is you're actually going to be depositing the money. You have to consider if you're going to be spending it. It might even be possibly escrowing this money, and you more than likely have to defer most of it. So let's talk about recognizing these franchise fees for your books. The codification 952-605-25, it's a mouthful, but it is the actual codification, says that franchise fee revenue from an individual franchise sale shall be recognized when all material, services, or conditions relating to the sale have been substantially performed, which is an important term, or satisfied by the franchisor. Just by looking at this, it says when all material, services, or conditions are substantially performed. Let's talk a little bit more about that. What would substantial performance be? Well, for the franchisor, it means that all of the following conditions have been met. 1, the franchisor has no remaining obligation or intent by agreement, trade, practice, or law to refund any cash received or forgive any unpaid notes or receivables. 2, it would be that you substantially all of the initial services, and initial services we've defined and discussed a little more earlier in the slides, of the franchisor required by the franchise agreement have been performed. And then lastly, no other material conditions or obligations related to the determination of substantial performance exist. Well, looking at this, you'll understand that it's important to identify what are your initial services. Then you have to understand when are those initial services substantially performed. What we'd like to do actually in the next slide is show you an example of what your books would look like. So here's a concept. I actually named it my awesome franchise concept. And in here, let's just go over some of the facts. In this situation, in this company, what they did was invested $9,000 of their own money into their business to franchise a concept. They sold a franchise for a fee of $100,000. They used these invested amounts primarily to cover some expenses to operate and probably some costs incurred as a result of trying to sell the franchise. So this is a very simplified financial, and the reason I set this up is so that you can see the effects of a company with very little invested. You know, as an accountant, what stands out for me here when I look at this, and what would make me worrisome, is that as a user of the financial, what stands out is the deficit. And it kind of makes me think, all right, what if this company can't operate without selling franchises? And for GAAP purposes, or generally accepted accounting principles, in this situation, the franchisee paid $100,000 for a franchise, but they're still receiving the initial services. So the company itself had to defer the franchise fees in this case and not recognize it as revenue because they're still haven't met all of the conditions of substantial performance. At that point, if at that point they are substantially performed, and it could be at any period of time, in this case, in this example, we're looking at one company where they received the fee right before the end of the year, very close to their end of their reporting period. What I mean by reporting period is if they're in a situation they're going to have to receive an audited financial statement and they receive their fees in December, you know, there's some planning involved in thinking about how would their financial statement look at 12/31. In this case, knowing that they're going to have a deficit because they can't recognize the revenue, they haven't substantially performed or met all the conditions of substantial performance, and they're going to have to defer this income, they have to think, okay, before the end of the year, what can I do to show a better equity? And in that case, they may even have to decide to put more money out of their own pocket into the business as an investment. Now, substantial performance, just to discuss it a little more, it has to be consistent. In most cases, companies have to decide, depending on the concept, what would be considered substantial performance. If you were a multi-unit, if you were selling franchises for fast casual restaurants, you know, it could be when the actual fast casual restaurant opens their doors and operates. In that case, then that has to be used as a consistent rule throughout all of their accounting of their franchise fees. So, you know what, we're going to have another poll question. See if you guys are listening.
Our next poll question is, what does Company A record on their books? The first option is $90,000 as deferred franchise fee. Second option is $100,000 as deferred franchise fee. And lastly, $100,000 as deferred franchise fee and $10,000 prepaid commissions expense. Please go ahead and submit your question on the screen, or submit your response on your computer screen. And we're going to go ahead and keep the poll open a little bit longer to give everyone a chance to respond. So in about 30 seconds or so, we'll go ahead and close the poll. Great, about 10 more seconds, so great. So I'm going to go ahead and close the poll and share the results.
Thank you. And the results, what they're showing is most are leaning towards C, and that is the correct answer. This probably could be a subject of a future webinar, but in theory, if you are collecting a franchise fee and it costs you money to actually go and receive that franchise fee, then in theory, for accounting principles, you can also show that $10,000 as a prepaid expense, so that you're not showing that as an actual expense when you haven't earned the money that caused or incurred that expense. And so that's the answer. The answer is C. I think that's about it on my accounting aspects of franchise fees. We wanted to make sure that we covered the definitions involved in the accounting guidance about how to recognize your franchise fees. We're going to open it up for Q&A right now and let you give us any questions about this subject. You can also continue to give these questions throughout the webinar into the end of the webinar. We can still answer accounting questions after Paul does his section, but feel free to ask any questions you have at this point. So we got one question here from one of our attendees. Thank you. The question that they're asking is, if a company has to escrow franchise fees because they have very little equity, how can that be prevented? Well, it's all about planning, I believe. At the end of the day, I think that you have to really plan out what your financial will look like when you need to present it to anyone. And it might not only be that you're including it in an FDD, it could also be when you need to borrow any money When you're following these accounting principles and you have to defer all these franchise fees, then at that point you have to kind of come up with how much money you may have to invest in your own business so that the equity, it doesn't show as a deficit. If it's for filing with states, and certain registration states are going to require a franchisor to have to escrow some of the money or even all of the money, at that point it's also probably a good time to also speak with a legal representation that you may have and find out what would the state prefer that the company, what kind of equity would the company need to have where they could be in a position not to escrow. There's no magic number. Some states are specific about it, other ones are a little vague, but that's something to definitely consider. Understand when you're going to be recognizing your revenues and understanding what your financial position would be at the end of a reporting period. Is there any other questions? I'm checking right now. No. All right, so now that I bored you with the accounting guidance, I'm going to let Paul delight you with all of his tax guidance. Paul? Again,
thank you, Elaine. I did find that very interesting, and quite honestly, I even understood it from the accounting perspective. But again, in all due respect to Elaine, this is the fun part, the tax work. I mean, quite honestly, one of the first things is, why does anybody care? Well, quite honestly, in terms of tax returns and tax liabilities, you do care in terms that you might have a tax payment where you might not have thought you did. And that's one of the keys. And what we'll also talk about is that typically you don't really, taxpayers really don't like to show income for tax purposes when they don't for financial statements. We had mentioned previously, one of the keys is that the results may not be exactly what you want them to be, but quite honestly, as long as you're aware of them, at least there's no surprises at the end. Deferred revenue in terms of general tax is a specific area that we deal with quite often, and it is very different from accounting treatment. Deferred revenue is one of the real areas that I see that have something what's called book-to-tax differences, where like Elaine will give me the financials and I'll do my what's called M1 adjustments. That I'll add income or subtract expenses that otherwise would not be allowed for GAAP or deferred, and then we come up with taxable income. Deferred revenue is one of those key M1 adjustments. We're going to be talking about what's called the 1-year lag rule. In that, this is Rev Proc 2004-34, which is very interesting because it's a Rev Proc and it has deferential treatment, but it's not in regulation, it's not in the code. The IRS had struggled with taxpayers over deferred revenue for so many years. They came out with this Rev Proc that again is very key in that does provide definitive rules. What are the general principles for tax? Again, there is a major departure from GAAP treatment. The matching principle is essentially ignored. In tax, a lot of times we'll go with matching and other times we're not. This is one of the departures, the reasons, one of the ways that we don't. What's the general rule? It's very nice and easy, and we could end the session now, but it says you basically report any income, accrual basis taxpayer, in the year that you receive it. That is the general rule. No matter what GAAP does in terms of deferral, it's taxable in the year of receipt, notwithstanding when it's earned. We're talking about obviously accrual basis taxpayers. We have GAAP statements, but cash basis taxpayers will always obviously reflect advance payments when they receive it. And again, as we mentioned, taxpayers typically are not overly excited to report income for tax purposes, pay tax, and not at least show it on their financial statements. So what is the Rev Proc? I had given the general rule, pick it up year one and be done with it. The Rev Proc provides a definitive exception. And I was kind of acting tongue-in-cheek because many times, and Elaine is polite, she won't say this, but a lot of times tax, I can't give definitive guidance. because a lot of times it's not black and white, it's gray. Here it's black and white. It's definitive guidance. So yes, that's right. In tax, this is definitive. There's two methods. One method is full inclusion. You just pick it up as income and you're done. Or the deferral method. Now the deferral method is a limited deferral, and again it's referred to as the 1-year lag rule. Essentially you follow GAAP for the year of receipt, and then you pick up the balance of the advance payment in the second succeeding year. It's as easy as that, meaning that I do follow GAAP. Year 1, whatever they do, I do for tax, and in year 2, it's income, and that's it. No matter what GAAP does, if they amortize it over 10 years, it's irrelevant. I'm going to be picking that up in the second year. And again, I did find interesting when Elaine was talking about substantial services, that concept, quite honestly, goes out the window for tax purposes. So how do you fall under this rev proc before we get into the application? First of all, you must receive what's called an advance payment. So we call it advance payment as compared to deferred revenue, but it's really the same concept. So the tax paid includes in gross income for the taxable year of receipt under a permissible method of accounting, but the taxpayer recognizes in revenue in its applicable financial statements, AFS, which we'll describe later, for a subsequent year. So it receives it, but under GAAP, it's picking it up as income in subsequent years, or if no AFS, the taxpayer recognizes when it's earned. What is the advance payment? It must be for the various categories that I had mentioned. Obviously, in terms of the franchise sector, services is key, but there are other areas other items of advance payments that fall within the Rev Proc guidance. Sale of goods, unless you're using a deferral method for merchandise. Use of intellectual property. I use this quite often, and it also has relevance to the franchise sector, such as copyrights, patents, trademarks, names, franchise rights, everything. Occupancy of property, but only if it's ancillary to services being performed. Computer software, guarantee or warranty contracts, subscriptions, membership dues, and I have this quite often, eligible gift cards. So you see that it's just not services, but again, the key areas I think in terms of the franchise sector would be services and IP. Does not include rent, insurance premiums, or financial instruments. So now let's get to the tax application. The deferral rule is clear. And again, it sounds redundant, but it's so clear you just have to continue quite honest to reiterate it. Essentially, one must report the advance payment over a 2-year period for tax purposes. And again, to emphasize, it's not relevant if it has a term or whatever. Over 10 years, it's irrelevant. I've got a 2-year pickup. And I think the best way of doing this, trying to understand the application, is to go through the various examples that I have here. So assume a taxpayer receives a $10 million advance payment in 2016. GAAP treatment provides for ratable amortization coinciding with when deemed earned, 10% per year. So I'm going to be looking at $1 million GAAP income over the 10-year period. What's the tax result? So again, going back to Rev Proc 2004-34, it says, okay, GAAP says that $1 million was earned in 2016. We'll follow that. And that's it. We're not going to follow them anymore. $9 million is reflected in 2017. And I'm going to go through the other examples, but it all just reiterates the general rule. What if GAAP says, no, you know what? We're going to do 1/3 amortization. So whatever the tax result is. Again, we'll follow GAAP in 16, and we'll pick up 2/3 in 17. What about 1/4 amortization, but only commencing in 2017? So I received $10 million in 16, but GAAP says, you know what? We're only going to start amortizing in 17. So again, I follow GAAP in 16, but in 17 I pick up the full $10 million. Another example, just in terms of the application before we get to the poll question, I'm sure you're waiting in anticipation for that, but in terms of another example, what if the following, what if you have a 5-year contract, and let's say it's $1 million each year, and you receive $2 million in year 1, $1 million for year 1, and $1 million for year 5. They give you an advance. And now GAAP says, you know what, we're going to be picking up $1 million when it's received, it's earned, they're going to be picking it up for GAAP purposes. So in my example, we received $2 million. GAAP says they earned 1. What do we do for tax? For tax, we pick up the $1 million because GAAP told me to. Then I go to year 2. In year 2, we pick up the $1 million that we received then. GAAP says is earned, but then I pick up that other $1 million that I received in 16 as income. So I'm picking up $2 million, and then again I coincide with GAAP over the remaining of the period. And now let's go to the poll question.
Great. Our third polling question is, taxpayer receives an advance payment of $1 million in 2017. For GAAP, the income will be deemed earned 50% in 2019 and 50% in 2020. What is the tax result? And the options are $1 million reported in 2017. Option B is $1 million reported in 2018. And option C, $500,000 reported in 2016 and $500,000 reported in 2017. And D, follow GAAP. Please go ahead and select the appropriate response and submit your answer. So go ahead and submit your responses, and we will close the poll in a few moments. We're just going to keep it open for about 15 more seconds to give everyone a chance to vote. Great, so I'm going to go ahead and close the poll. Thank you for participating.
So Paul, it seems everyone is awake. They're answering the poll question. You got your results here.
I'm so excited.
So it looks like 67% of you have answered C.
So let me go over that because 67% are wrong. So I wanted to, let's go through that example. I think it's important. Taxpayer receives an advance payment of $1 million in 2017. So I received the $1 million. GAAP says, you know what, it's earned 50% in 19
right,
and 50% in 20. What is the tax result? So again, if I look in 17, I say GAAP tells me it's not earned. But then I do the 1-year lag rule. In 18, I pick up the $1 million. So the correct answer is B. And if I may, not to be facetious, but Elaine and I were kidding because Elaine said to me, well, C is 16. They didn't receive it in 16. So how could you report it? So I just want to make sure that you understand that concept. And again, the fact is that we received it in 17. It wasn't earned. In 18, then the 1-year lag rule kicks in.
So Paul, if this is applicable to anyone who applies for this 1-year lag rule, and it gives them the ability to plan for tax purposes, you know, how to recognize it, because now they're given an extra year to be able to report it for tax purposes.
Correct.
Right? Okay.
Correct. But I mean, it's not earned, but yet you do have this 1 year. So you could get $10 million in year 2016, and if it's not earned until 17, you only report it in 17.
So if the correct answer is be, then it looks like even though they have the funds in 17 and for financial statement purposes, they're not going to be able to show this as revenue for another 2 years.
Correct.
But for tax purposes, they're going to have to pay a tax on that $1 million in 2018.
And that's the surprise.
That's
And
the surprise.
what we want everyone to realize is that tax has a little mercy, and they're going to have that $1 million.
Not only with this subject, I'm sure.
Correct.
We've actually received a question. Should we try to answer this now?
Sure.
Okay. We were asked, you are speaking strictly about revenue recognition, right? As long as the franchisor is not under a deferral or escrow requirement imposed by a state, there is no obligation to defer, correct? We are strictly speaking about revenue recognition. The second part of this question where it says about if there is an escrow requirement imposed by the state, if there is, it has nothing to do with the way you recognize the revenue. You would still be following the rules for tax and for GAAP when it comes to that amount that you're showing as deferral. So it won't make a difference.
I'm in 100% agreement.
Okay.
Thank you.
Yeah.
AFS. Because we had mentioned that when you're under the AFS, there's a specific procedure. So what's an AFS? It's called an applicable financial statement. Financial statements required by the SEC, 10K, certified audited financial statements, which would apply to the franchise sector, or financial statements required by the federal or state government or agency. If you don't have an AFS, or you're unable to determine the extent to which the advance payments are recognized in revenue in the AFS for the tax year receipt, you must include the advance payment in gross income for the tax year receipt to the extent earned in that year, and then simply include the remaining amount of the advance payment in gross income for the next succeeding year. Very similar, quite honestly, is if you did have an AFS. It's the application and the result is very similar. I wanted to go back in terms of the tax differences, if you may, before we go to tax change and accounting methods. Because we had mentioned again that there is going to be this diversion, if you may, this different treatment. So again, when I get financial statements from Elaine or whatever, I'm looking to do an accrual, I'm going to have these M1 adjustments. So again, I'm going to say, look, you didn't pick up this deferred revenue, but unfortunately I do. And typically what I do, in addition obviously to looking at the financial statement notes, I look at the deferred revenue long term on the balance sheet. And that gives me the real key as to how much has to be picked up. Because short term, I'm good with, because that's 1 year, that I'm good with that. It's the long-term portion that I'm concerned with. So I would look at what we call the swing. So let's say that the beginning deferred revenue long-term was $10 million, and at the end of the year it's 20. I look at the swing and I say, okay, hold it. I have a $10 million pickup and then one adjustment that I have to pick up as taxable income. Change in accounting methods. So I mentioned that there are two methods you use. One is the full inclusion or the 1 year deferral. And in most situations, I would say that the 1 year deferral makes sense. But when you get in terms of gift cards, there's various modifications and rules. So what if you're under a method? What if, you didn't listen to our seminar or webinar and you were under the full inclusion method? And you said, oh, this makes sense. I'd like to change my method. Anytime you do that, that's an accounting tax change. And you have to file what's called a Form 3115. And you have to tell the service, look, I had been doing it this way. That was a permissible method, but I now want to go to a method that I feel it's also permissible, is better for me. You're able to do that. Now, 3115, there's two procedures. One is that you must request permission from the IRS, and they must come back and say yay or no, or what's called the automatic consent procedures. And a change in accounting method relating to deferred revenue is an automatic consent procedure. So that means that when you're able to do that, you don't have to specifically ask permission from the IRS. It's automatic. What you would do is you would file the Form 3115. You have to have your tax return timely filed, and you would attach a copy of the return, send another copy of the 3115 to the IRS, but again, it's automatic. You're given audit protection, and the process, the 3115 is kind of complicated to complete. It's detailed, but nonetheless, you could easily change your accounting method to a better method without requesting pre-clearance, if you may, from the IRS. Then we get into what's called the Section 481A adjustment. What is that? We love to use code sections, but what it says is, well, hold it. If you've been under a method before, and now you switch to another method, you might have had an income pickup that you had to pick up, or maybe you have an extra deduction. How do you report that? Now, in terms, let's say that we have a deduction, meaning that our method before, whatever method that was, and we changed, we have an extra deduction in the year of the change. What would happen on that? You would take that as an immediate expense. Immediate. 1 year, current year, the change, you would take that as an expense, as a loss. What if you have income? What if by changing the methods you have to pick up additional income? Let's call it $10 million. Do you have to pick that all up in year one? And the answer is, fortunately, no. The Section 481A adjustment calls it a 4-year spread. So they allow you not the loss you get year one, but the income you could spread over 4 years. So for that, what did I say, $10 million? $1 million, you could pick up $250,000 per year. Again, we've done this quite often when we see that the method was not appropriate, and the automatic change obviously works quite well.
Now, Paul, just to ask you a question about what you just discussed, this only applies when a company's been operating for a few years using one method that's different from, let's say, the one year lag rule.
Right.
And they realize that it's a better tax strategy if they apply that method and not apply the method that they've been using.
Correct.
And be able to save more taxes, or maybe defer tax because they're able to now pay it in the next year rather than the current year, and that's when they need to formally request this accounting change with the tax department.
Exactly. It's when you were under a specific, again, a permissible method, and you're now changing to another permissible method. That's an accounting change. And as I had mentioned, there are many of these changes. Many are automatic, where, again, you don't have to go through the IRS and beg for their clearance. This is deemed to be automatic.
So when it comes to methods for franchisors and what you've discussed the 1 year lag rule and some other methods. It really just depends on the business and how they're receiving these franchise fees, how often, how large, and what their financial reporting procedures are, right? It really is a case-by-case thought process.
I mean, in most situations, I'm not saying it's a no-brainer,
yeah,
Elaine, but I would say that in most situations, Rev Proc 2034-34 treatment is appropriate. And, you know,
yeah,
if I'm looking at it from day one, that's what I'm going to use.
right. Okay, great.
But when you talk about others, like in gift cards, there's various other methods.
Right.
But again, that doesn't really relate, if you may, to the franchise sector.
Okay. Thank you, Paul.
Let's go to the poll question.
Great. Our final polling question is, an AFS includes a review for accounting purposes. And the options are A, true, B, false. So please go ahead and select the appropriate response, click Submit, and we will close the poll shortly. So great, I'm going to go ahead and close the poll. Thank you again for participating, and share the results.
Okay. You know, I used to teach as a professor, and this is, again, you're wrong. I say that in jest. But in AFS, because if you go back to the slide, it only includes 3 categories. One is 10K, SEC, one is a state or federal government, or a certified audit. So it does not include a review. Before I ask for any questions, I want to go back because Elaine had mentioned, I thought, an interesting question. I think if you looked at poll question 2 from an accounting perspective, she had talked about, what about the expense? And I thought that she said that, well, from a GAAP point of view. From a tax point of view, now I'm going to go back to that. If you want an answer there, it's not 100%. It seems kind of like a gray area. But let's go back. Can we go back?
So you're mentioning, what you're discussing right now is
expense.
Expense. Like, should we be deferring? Should we be showing it as a prepaid expense
Exactly.
for tax purposes? So is that, I guess, are you going to go over if that's an allowable thing, or is...
I'm going to go over that's gray area.
That's a gray area.
It's not definitive.
Right.
So let me tell you what we feel, what I feel. So if you go back to that poll question, can we do that? No? Well, then I'll read it. The poll question 2, where it has A collected a $100,000 franchise fee and had a commission expense.
Right.
So what is the answer from a tax point of view? The following, in that we have what's called economic performance requirements. And that basically means, in terms of a commission, if the service was performed. Really don't care what GAAP says. It's more of a tax concept.
Right.
So we have the economic performance. In that first year, I think there's a position to say that the $10,000, as long as economic performance was incurred, could be expense for tax, even not for GAAP. Why I say I think there's a position, again, tax is independent. Why I feel from a conservative point of view, I believe the better answer is that in here I would apply a matching concept, in that I'm not recognizing the revenue for tax purposes, and therefore this commission generated that income. I believe the better approach is to follow GAAP for year 1, do not pick up the $10,000 as an expense. But then what about year 2? What about if year 2 I have to pick up that full $100,000 for tax purposes? Under the RevProc, I have to pick it up. What would I do with the $10,000? Clearly there, I apply the matching principle. If GAAP defers that 10, I don't care. I would expense that 10 against the 100,000 that I'm recognizing, again, under a clear matching principle that that was incurred to generate the fee income, and if I'm recognizing it, I sure should be able to take the expense against it.
So that sounds like great news, because for a company, they would be able to show that as an expense and basically reduce their taxable income.
Exactly. Okay. And again, it's matching, but it does kind of make sense, because it's like tax is saying, well, look, I don't care what GAAP says, you got to pick up the income, but it would seem inequitable. I feel there's support for saying, well, if you make us pick up the income, but then you want us to follow GAAP for the expense, that seems inequitable. So right. I would definitely take that $10,000 when the revenue is recognized, but I think there's also a possible position of taking that $10,000 when the expense is incurred, as long as economic performance has been met.
And this is why I'm so glad that I have you as my associate, because when I have these concerns, I can just call you up and deal with them directly with you, and I don't have to memorize them myself.
And we don't even have to do it through a webinar.
Yes. But let's go. I guess I want to summate where we are. And here we go. Here is, just to simplify, what are the real differences between books and tax? So for books, you could be deferring for more than 1 year. It can be many years. In some cases, a franchisee may not actually open their doors and take 3 or 4 years for you as a franchisor to perform those initial services for them. And for tax, which, sorry, Paul, that I made you a little lady, but
no problem.
For tax, what is the real difference? For tax purposes, you could be paying tax on an income that you have to escrow and you can't recognize for books and you can't show as revenue. I mean, that's really the real differences between us, other than we're different cartoon characters.
Right.
I think we can go into any tax questions from any of our attendees. Feel free to type in any of your questions right now before we conclude our webinar.
Great, thank you, Paul. Thank you, Elaine. And as we mentioned, we're now going to begin answering the questions submitted during today's tax treatment portion of the presentation. As a reminder, you can still submit questions through the questions pane in your attendee control panel.
Okay, here's a question. Does an AFS, does that include a review for accounting purposes? I'm not giving that up. Now, one question that we had was more or less the application. And again, to go back to the general rules, it's assume the following was the question, that if you receive $500,000 in year 1, and GAAP says that you do not have to pick any of that up until year 5, what was the tax result? And again, that goes back to one of the other polling questions where simply that $500,000, that's really what Elaine was saying. You do get that 1 year limited deferral. You have the money, you don't have to pay tax on it. But then in year 2, regardless and notwithstanding whatever GAAP says, the $500,000 is picked up as income.
Okay, thank you, Paul. I don't see any other questions from our great attendees. I think we're okay to conclude our webinar. I want to thank you all for joining us today. We really appreciate your time and your input and your questions. And we also look forward to any suggestions for any future webinars that you would like us to host or our firm to host on any type of subject that you feel is important. We're definitely obsessed with the franchising subject, and
yes,
we would be more than glad to provide future webinars on this subject. We thank you again, and we wish you a good day.
Elaine, thank you. Same here. It was a pleasure to be participating in this webinar. And again, if there's any follow-up questions, obviously you could send that, and we'd love to respond. Thank you.
Thank you, Paul. Thank you, Elaine. And thank you, everyone, for attending today's webinar, Franchise Fee Pitfalls and How to Identify Them. If you have any other questions, please contact Elaine or Paul. Once you leave today's webinar, you will receive a survey on the presentation, and we would appreciate if you would complete that and provide your feedback. If you require CPE, please make sure you submit your survey to receive credit. You will also receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar. On behalf of Citrin Cooperman and our presenters, thank you for joining us today and have a great rest of your day.